Hi, I'm Andrew Savickas, publisher at yieldtalk.com, and today I'll be talking with Charles Clinton, the co-founder and CEO at the alternative investment platform EquityMultiple. Prior to founding EquityMultiple, Charles worked as a real estate attorney at Simpson, Thacher, and Bartlett, where his primary clients were a few firms you may have heard of, Blackstone and KKR. Charles, thank you so much for being here.
Thanks, Andrew. Great to be here.
Right. So, Charles, you're the CEO of a commercial real estate investment platform based in New York City. Is it safe to assume it's been a challenging 2020 for you so far?
It's definitely been an interesting one. I think in the scope of issues that both businesses and people have faced this year in this country, we've been very fortunate. But on the other hand, we did have to rethink basically all of our operations and strategy. It's a very different business climate than it was a year ago, and it required a lot of quick pivots, but we feel like we're in a good place.
Oh, I'm sure. So, more specifically, how have you been affected by, COVID-19 on the investor side of the equation?
So, I think you've probably read about companies like Robinhood and the explosive growth in new users. And I think that's been true across the kind of fintech sector and the wealth tech sector. Um, More people are at home, more people have time on their hands that they didn't have before and are, I think, exploring options like this. We've really had better volume on the investor side than we ever could have predicted. Organic new user growth, people just finding us by themselves without any kind of marketing spend, was some of the best we've ever had over the last few quarters. And, in talking to other platforms, inside real estate and out, it seems like that's a kind of broad secular trend right now.
Yeah, I've heard that as well, and certainly even seen that in traffic on my own site. I think, there was definitely a bit of a dip when things were really bad in March and April, but since then has really been a lot of increased interest in what's happening on the alternative investment side. Now, how about on the sort of deal side of the equation?
Yeah, that's definitely been the more challenging side. Basically, we had to throw out our underwriting rules in the middle of March. Everything that would have been a good deal in March 14th or whenever we closed down because of COVID-19 was no longer a good deal, 2 days later. And, that really led us to substantially reduce our volume for a few months. On the kind of pure market dynamic side of it, the market really dropped out. The transaction volume in real estate plunged. A lot of that was driven, of course, by just buyers and sellers having this big disconnect on what is the value of any kind of asset, given all the unknowns there are right now. The other side was, the activity of lenders. So, the capital markets really froze up in a material way. A lot of banks just said, we don't want to lend right now until there's a little bit more stability. We are seeing that change. I would say, the last 2 months, there's been a really significant thaw. Lenders are back in the market in a significant way. Transaction volume is increasing. It's not a flat thing, right? I mean, it's not affecting all areas equally by any means, but there's pockets where there's really good opportunity right now. So those sectors are definitely re-engaging.
Okay. Okay. That must be a challenge having to kind of throw things out the window and start from scratch on your deals that make sense before and after. So there's a lot of talk about how, again, the sort of the before and after thing. This is accelerating trends that were already to some extent in progress and we're going to happen, but maybe in 5 years, not in 5 days. Now, are you seeing that happening in commercial real estate as well?
It's interesting. Commercial real estate is always called the lagging indicator because it's all private market transactions. It just doesn't have the day-to-day reactiveness and volatility that the stock market does. And that's both a asset value thing. Asset values won't drop 30% the way the market did back in March and April. But you also won't see the impact of changes in the way we live filter into commercial real estate for a long time. And I think the other piece of that is, changes to the way you live are, it's hard to prognosticate whether they're short or long term, especially right now. I'd say the two areas where we would highlight trends that are probably accelerating. The most obvious is retail. Traditional retail has had real headwinds as e-commerce has become more and more of the market. Really Amazon is a threat, existential threat to retail, at least as we knew it. And the retail industry has been transforming bit by bit, and this will certainly be an accelerant for that. You've obviously seen what the share prices of Amazon and other e-commerce companies have done over the last few months, and I think that's the market saying, we do see this as fuel on the fire for a trend that was already there. The other is, work from home. Obviously, work from home has started to filter into, before this, it started to filter into even the largest companies, the bigger, more institutional, more formal employers, law firms, banks were the slow ones to adopt that, while it was the norm at a lot of startups and tech companies, at least part-time. And I think that now every business is looking at what is the split of remote versus working in person. That said, I think, I don't know about you, but I do, and I think a lot of people feel differently about remote even today than we did 2 or 3 months ago. It is one thing to be remote for a day or two a week, and it's another thing to have your whole life be inside your house and not have those opportunities for collaboration, and also just have your life and your business bleed into each other. So I don't think that this is the death of office by any means. I think it's just going to look different, and it will accelerate a trend. But I imagine that trend is more how maybe you'll have teams that work partially from home some days of the week and partially in the office other days of the week.
Right, right. Now you touched on something there, talking about how there's different sectors here. So there's, commercial real estate in the terms of office space. There's commercial real estate in terms of retail. This is not a monolithic thing. There's presumably a lot of variation among these different classes. Retail, hotel, medical, multifamily. You guys put together, I thought, a nice overview on your blog a while back, kind of diving into how things look in each of those different kind of sectors. Without getting into a ton of detail there, from your perspective, how are things looking at, when you look at different categories of commercial real estate, what are you seeing in terms of how they're performing differently in this, crazy context that we're all living through?
Yeah, I mean, I think you absolutely have to break them down because the challenges and the opportunities are pretty different at this point. It can be wildly different in some cases. Retail, I mentioned, I think that was an area that we already saw as challenged, where we were not offering a lot of investments. I think we've done 3 ever. And I think this really keeps us fully hands off on that space, at least until it stabilizes a little bit. Hotels are another area that, of course, have been particularly challenged by just this immediate cutoff of all tourism. That is starting to come back, and my suspicion is for hotel operators that can hold out, until there's a vaccine and until tourism starts to, be more normalized. I think on the other side of this, we could see a massive surge in demand, just given how pent up people have been for so long in so many major markets. The areas where we're actually seeing, I think, strength in some ways are multifamily. Collections are an issue, and I think will continue to be an issue. People are not all going to pay their rent. A lot of people have lost their jobs, and stimulus has helped in some places more than others. Some state unemployment has been, I think, really propping up collections in some places. But in the larger sense, you do like the diversification of your income stream. People always do need a place to live, of course, and some a more nitty gritty dynamic that's happening right now is the cost to lend, or the cost to borrow rather, within multifamily has actually gone down because the treasury rates have gone down. So a multifamily deal that might have had a loan at 3.5% or 4% a year ago can now borrow at under 3%.
Wow.
On the other hand, cap rates, which is kind of the metric that real estate is bought and sold on, they haven't really adjusted to that. And typically those have a very direct relationship. So right now there's a really interesting opportunity inside multifamily where you can buy sort of at the same cap rate you've always been able to buy at, but you can borrow more cheaply. So you can create more yield. I think that opportunity will close. Historically, those have those have narrowed, so that they, it's not always one to one, but there's a very strong correlation. So, we really like multifamily in part for that reason. Feel like it's has better resistance built into these kind of recessions, but also because the borrowing dynamics really strong right now.
That's very interesting. So obviously, looking at categorizing it by sector is one way to sort of slice and dice opportunities in commercial real estate. But another way to look at it is geographically.
Yeah.
And certainly we're seeing some dynamics here with San Francisco. People are leaving, and rents are dropping, and some similar reports out of New York. Where is your team looking right now geographically for opportunities in some of these new deals?
We're trying to look through past COVID world with some of that stuff. I think ultimately, I do think that there will be a normalization in these major markets when you have a vaccine, and life starts to resemble what it was. I think it's important to remember that it will. And it's always easy to overestimate the present moment in the present moment. So, New York has other challenges around buying, especially in multifamily because of rent regulation. But there is, of course, always a value opportunity when other people see something as very distressed in the present moment, if you think the long-term value is there in the future. So maybe not New York specifically, but I think San Francisco, to say that market is going to die because of this in a significant way, I think it'd be foolish to do that. We really look at always, historical growth and demographics. And, between those two, you're kind of getting a little bit of your backwards looking view and your forwards looking view. Demographics are a great predictor of long-term growth for a market. So if you have young, educated people, you'll tend to have, economic growth and rising rents. So, I think we always have been attracted to the Texas markets for this reason. We've done several multifamily deals in Texas over the last 2 months, and there's definitely temporary pain there because of both COVID and the oil and gas hit. But in the long term, you just have had such sustained population growth in the major metros there, that I think it's still a good bet to be making. Similarly, maybe an area like Raleigh-Durham, the Research Triangle, just a place that has seen an influx of talented young people, that portends well for the future.
Okay, thank you. Um, you know, Real estate remains very popular among, if not the most popular, among all the different alternative investment offerings available online now. But there's also been, especially in recent years, a big surge in new asset classes coming online: litigation finance, art, fine wine, cars, collectibles. What role do you see commercial real estate playing in an alternative investment portfolio when people have so many options now, as they're looking to sort of round out their holdings?
Well, I'll start by admitting my answer is obviously very biased here, as a platform that's just focused on commercial real estate. But I just see real estate as foundational to portfolio construction, in a way that other alternatives aren't. Not to say that there isn't a role for other alternatives, but real estate is a bit different. I think it's in a class of its own. For many people, it's called the fourth asset class. You have stocks, bonds, cash, and real estate.
Mhm.
That's really entered kind of mainstream financial parlance in the last 2 decades. So, it makes a lot of sense to me why other platforms that don't have real estate exposure would be trying to branch into that, because, it is where there's a lot of investor demand, and it's a natural entry point for a lot of investors. It's less speculative. It has cash flow. It has appreciation, and people are familiar with it. Everyone knows a little bit about real estate just by virtue of how much they interact with it in their daily lives. Like I said, I do think diversification into other alternatives absolutely has a role in portfolio construction too. But I look at those as later steps.
Got it. Well, you said people, usually do know something about real estate. You maybe bought and sold a home at least, perhaps, or
Sure.
even just some familiarity there. But if there is an investor who's new to, commercial real estate investing, what are some things that they should know before making their first investment, be that in equity multiple or otherwise?
Yeah, I mean, I think education is really the key. You and I have talked about this offline too, and I think it's part of why we really support what you do, and some other blogs do also. Really, it's up to the investor in some ways to take that step and start understanding the basic dynamics of what they're going to be investing in, because I think that's always important. The flip side of that too is thinking investors being honest about their investment goals. What is their time horizon? How much risk tolerance do they really have? Because when you're educating yourself about this stuff, that should always be the backdrop. Because even within real estate, which is more conservative in terms of both potential for return and potential loss in some ways than something like venture capital. Even within that, there's a big range of kind of risk and return profiles. I think learning about at the outset different options within CRE. So, whether you're investing in multifamily, kind of property type stuff, or also whether you're investing in debt, whether you're investing in equity, whether you're investing in preferred equity, which kind of falls somewhere in between. Just kind of understanding the products, basically. Also understanding where you're going to be investing, who you're investing with. So the platform, what is the role of the platform? Are they just playing matchmaker between you and the opportunity, or are they actually negotiating on your behalf? Are they, there to handle reporting and things like that for you on an ongoing basis? And then, the experience of the actual real estate operator. Is this their first rodeo? Have they been doing this for 40 years? All that stuff makes a difference. And, that's more opportunity specific, but it is, I think, a great place to start on the opportunity. For equity multiple, we view education as just so fundamental to the experience that whenever an investor signs up, we immediately put them in touch with a lot of resources, right? So they'll get what we call the learning series. They'll get emailed sort of incremental pieces of info that cover different topics that we see as foundational. Also have a resource center that's built out with articles on a huge range of subjects that really range from this is my first time doing this to I'm trying to understand the real nuance of this.
Yeah, you mentioned something there I want to talk a little more about, and that's, that there is, it's not just about understanding these different asset classes, that there's this important distinction among different platforms where some of them, on the one hand, one end of the spectrum take a very curatorial approach with, selecting which investment offerings are there, so that it represents again, a real curation approach. And then the other end of the spectrum is really kind of just a facilitating a marketplace where, the idea here is that, the crowd can choose, people are smart, can make their own choices, just going to facilitate the transactions. And, I'm not necessarily saying one is better than the other, but something that's come up in my own conversations is, I think a lot of investors, at least just getting into this space, don't always know sort of where things lie and why it makes a difference. Can you say a little bit about sort of the approach you take at Equity Multiple, and maybe more importantly, why you take, the approach you do versus, taking a more sort of open approach that we see from some of the other platforms?
Yeah, I mean, I think that we really see ourselves as gatekeepers. That we are screening a huge range of opportunities to ultimately show very few to the end investor, and that's not to take away anything from the end investor and their intelligence or even experience. A lot of our investors have experience investing in real estate, and all of them are intelligent. It's really about information asymmetry. At the end of the day, the real estate firm is professional and they have access to all of the information about the deal, while the investor, on the other hand, is not professional, at least most of the time, and they're getting all of their information secondhand through real estate sponsor. And I think that is just a fundamentally challenging relationship, because there's always going to be an information divide. So we see ourselves from a platform perspective as better situated to bridge that gap. We have a professional team of people who have done real estate acquisitions for 10 years or more, and they know where to poke holes. And we do a lot of that hole picking before the investments ever get onto our platform, to at least save some time and effort for the investors, so they're not sorting out everything kind of from scratch. The other side of it is collective bargaining. Is kind of the way we look at it. So when investors invest directly with the sponsor, if they invest $10,000, $20,000, $50,000, $100,000, whatever the case may be, they're going to be a small fractional owner, of the apartment building, say. And what we do is we aggregate all of the investors into one equity multiple investment vehicle, and then on behalf of all investors, we negotiate rights with the sponsor or operator of that deal. So if they want to sell it at a price that doesn't return the investment, then they would have to run that by us. We can basically be another voice advocating on behalf of investors, rather than just relying on the operator.
Yeah, something else I think that investors can benefit from that approach. And in my own experience, I invested in a multifamily complex in Connecticut through Equity Multiple, and I really liked getting those quarterly updates where you get photos of the units as they're being renovated, and updated list of rent rolls. I mean, it was really a comprehensive list of things that I don't think I would have gotten that level of detail if I was just one investor, among a bunch of others, as you pointed out, the sort of collective bargaining side.
We also, we try to standardize as well, right? So that, for some of our investors are in 30 deals. And if you're getting 30 different reports, and some of them are no information and some of them are a lot, but all of them are different, I think it becomes really hard to understand with what's actually happening in your portfolio. So, we take all those inputs and we put them onto a single output. So, whether you're investing in an apartment or Connecticut, or an office building in Chicago, you're getting the same type of report with the same type of information. Everything's a little bit more apples to apples.
Yeah, absolutely. Now, you talked about kind of poking holes, kicking tires, poking holes in opportunities that your team's able to do. Can you maybe provide an example of a kind of kind of a deal that you would pass on, and why?
Yeah, I mean, there's so many reasons why we pass on deals. It's hard to kind of narrow it down. So, I think the first thing that you look at, besides the sponsor's experience, is going to be market comparables. How does the price of this that they're buying it for look to compared to other things in the market? But then also their assumptions, right? So, and that's one of the areas where I think having experience and then also having access to good databases is powerful, right? So, are they saying that they're going to improve rents? The market's going to improve 3.5% a year without them doing any work. We can look to see what the historical has been. We can look to see, what an economist says is the projected future growth in this market, and see if these are sound, or whether, either they don't know what it is, or are trying to pass off something to investors that just may not be accurate. Similarly on expenses, right? So we've seen so many deals that underwriting expenses is a very, very important thing, but you can benchmark it against things you've seen in the past. So for an investor looking at a deal on a one-off basis, it's hard to know is this a normal amount to spend on your accountant, whatever the case may be. I mean, there's 20 routine expenses. Is this a normal amount for this portion of the construction budget for unit renovations? Once something is up and running, is this the type of margin that you can expect on this type of property at this size? So, I think we have a ton of data points on all of those pieces of underwriting that we can, use to validate whether the sponsor is approaching the project correctly, whether they actually have a reasonable chance of success of hitting the numbers that they're putting in front of us and putting in front of investors.
Right. Okay. So you mentioned that you've got investors that are often in multiple offerings, multiple properties. And originally, you offered only individual investments. So it was, here's a number of available properties. You can decide which ones you want to participate in. But recently, you've added some funds into the mix. Now, what's your kind of target in terms of where what you'd like to see in terms of the mix between funds and individual investments? And for you, are there trade-offs between doing those?
Yeah, I mean, I think we are at about 10% now of our investments or funds by volume. We plan to increase that slowly. We have only started doing investor education around what are the pros and cons of fund investing versus individual investments. So I expect as we do more and more of that, we'll increase the percentage of investments flowing into funds versus individual deals, because I do think that they are in some instances a substitute, but in most instances a complement to a real estate portfolio that has individual investments in it also. The major advantage is on day one, you have diversification. You're investing into something where without you doing anything more, you're going to be in a range of different assets. On the other hand, of course, you don't have visibility in the same way. So you're investing into a strategy, and then the manager is really taking the discretion to invest into these other investments over time. So, I think that for some investors makes it a little harder because there's a bigger leap of faith. That said, especially on the fund side, we try to partner with managers that you should feel very comfortable taking that leap of faith with. We recently launched a fund with one of the largest real estate focused asset managers in the world, and one of the most respected. And I think that is a pretty unique opportunity, because on an individual deal basis, those kind of opportunities aren't showing up on platforms like ours, just because the size is too large. So to have access to that kind of manager with that kind of track record through a diversified vehicle, I think is pretty compelling. One thing that investors should be aware of, I think, about funds is oftentimes they're longer dated. So their duration could be even 10 years, which is tough for a lot of investors, especially new ones to the sector. But we've really tried to focus on funds that have liquidity. So maybe it's after a year, you're able to raise your hand and say, I want to be liquidated. Sometimes that will happen right away. Sometimes you'll be, kind of paid back as investments get realized, but have some sort of option for limited the duration if you don't want to be into something that's so long term.
Got it. Got it. Okay. Now, earlier we talked about how there's a lot of platforms out there coming on in with different asset classes, startups, art, fine wine, whatever it is. And also something else that's happening is the number of platforms offering real estate is, in addition to other things, is really picking up. So, recently Republic, which started with all about startups, and they've now added, real estate as part of it. Start Engine is again, started with kind of startups raising, and now they're adding real estate into the mix, including some that are available to non-accredited investors. Eventually, there's got to be some constraints here, either on the investor side or the deal side. What's your perspective on how this is going to shake out in terms of what this ecosystem might look like a few years down the road?
Yeah, it's a good question. I mean, I think, as I said before, it's easy to see why these companies want to get into real estate. I think it is a great entry point for most investors. There's cash flow, there's relative stability compared to venture investing. All of those things, do make a difference for people who are putting their toe into this space. It's obviously it's a massive market too, which is another reason why you see so many people, I think, trying to attack it. Obviously, again, this is my own bias, but I do think that the specialist platforms have a real advantage. Mainly because that kind of vetting side of things, it's just hard to be good at 10 different things at once, especially when you're a young company. And that includes the sourcing piece of it, finding good opportunities, the vetting piece of it, and then for platforms that do it, that kind of ongoing management and reporting piece. At the end of the day, investing in startups and investing in real estate are completely different. The dynamics are completely different. Not to say that investors shouldn't think about investing in both. But at least for the investment professionals, it's a totally different team. So, our thought is that right now, that sort of specialization makes a lot of sense. But long term, I do think that consolidation is inevitable, because from the end investor's perspective, having one place where they can invest in a range of different types of alternatives, they can really manage their whole alternative portfolio in one place, makes all the sense in the world. So, from how we're thinking about it is that the first thing is just getting to real scale. And that's the time when there's some sort of consolidation with another platform or an acquisition, or hiring a team that has deep specialization in another type of vertical, like venture or corporate debt. I think there's a lot of areas of potential growth. But that is, when the industry overall is a bit bigger.
Sure, sure. So I want to just briefly circle back to the impact and influence of COVID-19 on this landscape and ecosystem, because there's something you
Sure.
said when we had a conversation, another conversation, and you talked about the importance of having what you call a COVID thesis around new investments, and certainly I expect that you have that and you evaluating things from Equity Multiple, but it sounds like what you're really trying to say is anyone looking at any new investment right now should have a COVID thesis around what they're trying to do. Can you elaborate a bit on what you mean by that?
Yeah, I mean, I think generally speaking, you should always be thinking about the macroeconomic trends that will impact the future and how those will impact the viability and success of your investment. And right now, COVID is impacting people's daily lives in such an extreme way. And I think whether there is a more meaningful recession because of it will also impact the future of any investment in such a meaningful way that it has to be front and center as you're thinking about how to deploy money, and including into the stock market. Can the market keep going higher, or will we see more of the return of what happened a few months ago? I think that for an investor evaluating anything, it basically has to be in their mind right now. That said, I think the flip side of that is a little bit what we touched on before, which is you have to try to look through the present moment also. So, when we think about a COVID thesis, it kind of falls into two categories. One is something that might be in a position actually to benefit from the moment. And that could be because the business plan of it has some resistance to it. The demand for it seems stable. One area we've done several car wash investments, and we've seen basically no impact whatsoever during any period of COVID on their revenue. Even for things that opened up while this was happening, revenue continued to climb, and they have a subscription model. In part, they signed up people for new subscriptions. And it's just an area, maybe it's because there's a cleanliness focus and people are thinking about that more, but whatever the case may be, it showed real resilience, in the face of this. And then I think the other side is, thinking about if there's a business plan that kind of connects where you are today to, get through the painful period into the future, right? And that might be, this is not something we're looking at right now, but, maybe in 6 months, you're looking at a hotel that has done horribly over the last year, but you now have an opportunity to buy it at such a discounted value to its value of a year ago. And you think, all right, well, a vaccine is going to come. There will be a return to normalcy. So can we bridge through whatever period of pain is left, and then ultimately find real value on the other side? So, it's a huge range of specific theses, but I do think everyone has to be filtering through this lens at this point when they're considering any sort of investment.
Well, thank you. I really like that example. I would have not. I mean, it makes sense. It sort of seems obvious that you say it, but the car wash example is a super interesting one. Thank you. Um, just kind of going back in time a little bit. What inspired you to start Equity Multiple?
Really lack of access to commercial real estate investing. I was in the odd situation of working for, Blackstone basically every day, but wanting to put my own money into commercial real estate because it was something that I knew and I had some comfort with. And when I looked around at how to do it, I found myself going into Brooklyn on the weekend with a friend and looking at, dilapidated brownstones that we could try to buy and fix up. And that just seemed like such a crazy disconnect to me. So, when the Jobs Act changed what online platforms could do, it seemed like a natural way to correct this huge imbalance that you see, between what institutional investors are doing and, what normal investors are doing.
Yeah, it's funny you say that. I had a similar experience myself, kind of, kicking around single family homes, deciding whether I wanted to try my hand at flipping them, and pretty quickly concluded that was not for me. So I was very excited that there was a lot of other new opportunities, new ways to get into the asset class than rolling up my sleeves.
It's a lot
So
of concentrated risk in that stuff too, is the other side of it, right? Is,
yeah.
part of what we try to do is keep our minimum investments low. So, you can spread it around. On average, each of our investors has invested 3.6 or 3.7 times with us. So, we do find that behavior that we want is what investors are actually doing. They're creating a portfolio.
Hmm. Absolutely. So, one sort of final question, and this is a question I try to ask, everyone who joins us. What's your favorite book on money or investing, and why?
Um, let's see. I'll give you my dorky answer, and then my perhaps slightly more honest answer.
Okay.
So, I will copy Warren Buffett and say the Intelligent Investor. It lays out the basics of value investing, which I think is how I look at it. You're looking at, there's a basic relationship between risk and reward, but you're looking for opportunities where that relationship is not as one-to-one as it usually is.
Mhm.
Finding something that is underpriced for whatever reason, versus its intrinsic value. So, I think reading that definitely left a real mark on the way I think about all of the world of investing. And I think in terms of actually enjoying the read, I mean, I love Michael Lewis's stuff.
Yep.
Love Moneyball and love Flash Boys. I think he just has such a gift for making that more than a finance story.
Absolutely, absolutely. There's a lesser known book of his that I just stumbled across serendipitously, but it was fantastic. It's called Boomerang. So if you have a chance to come across that one, I highly recommend it.
No, I haven't read that one. I'll check it
It's
out.
great. It's great. Well, Charles, thank you so much. I really appreciate you making time to talk with us today. I appreciate your insight, and thank you for being here.
No, it was a real pleasure. Always great to talk to you, Andrew.
All right. Thank you, Charles.
Thanks again.